Well, we've known since the mid-19th century what you do when you have a financial crisis. The central bank has to supply liquidity on demand. They have to be a lender of last resort. So we know what Bagehot argued was that you lend without limit. You really have to lend to almost everybody. You lend against good collateral, and you lend at a penalty interest rate. Okay, he argued that that increases the efficiency of the financial system. So anyway, what did we actually do? Well, it took the Fed a while to realize that it needed to lend without limit. However, it didn't make the troubled financial institutions come to the Fed to borrow. They thought that that would send signals that there's something wrong with these institutions. They didn't want the stigma attached to having to go to the Fed and borrow. I think that was a big mistake. Look, the financial institutions were in trouble. There was no reason to hide that. They should have been forced to come to the discount window. Instead, what the Fed did is it used a series of special facilities where basically the reserves were auctioned off to bidders for the funds. So I think that wasn't done in the right way, and it also took the Fed a bit too long to realize that it needed to do this, be a lender of last resort without limit. The second thing that was problematic was that they lent against really anything rather than against good collateral, which was the recommendation. What this meant was that we're not necessarily lending to healthy banks, because the thinking always had been that, yes, you need to lend, but you don't use this as a way to bail out insolvent institutions. You're supposed to be lending to solvent but illiquid institutions. By lending against any kind of collateral and possibly lending against trashy assets, you could be confusing a liquidity problem with an insolvency problem, and I think that is exactly what the Fed did. And the third thing was they did not lend at a penalty interest rate. They lent at highly subsidized interest rates, so far below market rates rather than slightly above market rates, which is what they were supposed to do. So in all those ways, the Fed deviated from fairly well-established procedures for dealing with a financial crisis. So the other thing the Fed did was that almost all of this took place behind closed doors, even though the crisis went on and on and on. Now, I think there's a very good argument that in the height of a run on banks, you do this behind closed doors. You do it quickly, and then later you can talk about what you did. But in the heat of the moment, you don't talk about what you're doing. But of course, the crisis went on for years, and the Fed refused to supply any information about what it was doing until finally Bloomberg, a news service, used the Freedom of Information Act to sue for the information. And Congress started getting upset about this too, that the Fed was refusing to tell our elected policy representatives what it had done. Finally, the Fed released the data in raw form in 29,000 pages. Bloomberg did some analysis of it, and then two of my graduate students who were working on a Ford project with me went through the data in detail and found out that if you add up all the loans that originated in these special facilities that the Fed had created, it totaled $29 trillion. That gives you an idea of how bad the crisis was. Okay, $29 trillion of lending, and in some ways we're still not out of this. The other thing was that this was not short-term lending to resolve a liquidity crisis. It went on for, some of the lending went on for 4 years. A lot of the lending went on for 2 years. So we're talking about a very long-term problem in the banking system. Again, this does not look like a liquidity problem. This is an insolvency problem. So it sure looks like the Fed was lending to insolvent banks that probably should have been resolved, that is closed down, rather than kept open. The other thing is we've begun to look in detail at the interest rates that the borrowers paid. They weren't just below market, they were unbelievably low interest rates, a few basis points in some cases. Lots of loans well below 1%. So this sure looks like, again, what the Fed was doing was subsidizing their activities so they could get very cheap sources of funds, hoping to work their way back to solvency. And this is not what a central bank is supposed to be doing. You're supposed to shut down insolvent institutions. So in all those ways, I think that what the Fed did is really not consistent with established policy.